No, I think I should start by saying what I'm not going to talk about, because we have presented a previous paper in a couple of conferences, and there are always questions about digital currencies and so on, things that we really do not care about. So to be, let's say, rough, you could distinguish three sorts of, let's say, crypto assets. Some, such as Bitcoin or altcoins, are basically commodities from a financial point of view, except that they are intangible and they have no use value, but okay. Others are like an exchange-traded fund, but they are traded in, very opaque and unregulated markets. And then you have the third kind of currencies, the only one that I'm going to talk about today, and these are the ones issued by the central bank. So I really stress that the only relevance of digital currency in this kind of tool is that it has finally become feasible to do things that were possibly, I don't want to say impossible, but very hard up to this moment, which is, for example, opening up a bank account for every single person in a society directly with the central bank. So it was not impossible before, if you think of the post office, for example, but it was really unfeasible from many points of view. So where do we stand on that path? The most advanced experimentation you might know is the Chinese one. They have launched E1 since their Olympics, more or less. This is mostly used for, to be honest, for international transactions in order to avoid using the SWIFT system. So it's really something, again, that I'm not going to talk about today. Then there is kind of the surprise move by the ECB last month, because whereas the Fed was a little bit more advanced in studying this issue, last month the ECB had decided to conclude the investigation phase, and they have started what they call the preparation phase. Currently, the plan is to allow intermediated accounts, so again, not direct or what we will call retail accounts with the central bank, up to 3,000 euros for each citizen. So it is only aimed at households and not at firms, which more or less will account for, let's say, up to 5% of GDP, to give you an idea. Now, there are many details in how you could design a digital currency. I will show you an example in which we consider a retail CBDC, that is to say, really an account of every single person, even firms, if you want, directly with the central bank, simply because it's easier rather than intermediated ones. Some proposals have considered cash-like currencies, something that if you wanted, the central bank could even impose an interest, or on the contrary, the interest could be negative. So a discussant, I think, at the store last year commented that it is not precise, but I think it's insightful. Commented that it is like as if every family has directly access to bank reserves, more or less. Then there is also another strongly felt issue. Should this sort of issuance of money be considered as a grant or as a loan from the central bank to people? In the example that we will show, we consider a loan open-ended, so there's no real obligation to pay it back. It's still, from an accountancy point of view, it's a loan, but I can also show you with the same account that it makes no difference whatsoever. So really, it's, I think, well, it's not, for our aims, it's not crucial. What is the literature on these topics? Sorry? No, please tell me.
No.
Yes, of course. The new governor of Italy's central bank has been at the head of the study program at the ECB. The BIS is very much involved into this debate. To be totally frank, they mostly focus on money as a means of payment. So my impression is that they are mostly scared about the possibility that Visa and MasterCard become obsolete, and they want to be part of the new game in town. However, what I will focus in today is that, be it an aim or not of the central bank, money is also a store of value. And that is what I am focusing in today. So in a previous paper, we had discussed what could be the effectiveness of issuing CBDC in terms, for example, of employment and GDP impacts. And to cut a long story short, the main point was that there are very serious concerns, I think, among central banks that if they were to issue a CBDC at large scale, there could be a problem for bank deposits, because people could perceive a direct liability of the central bank as something more safe than a deposit with a bank, a commercial bank, and therefore banks could suffer some sort of capital flight internal in the economy. In the paper, we show that actually there's also a possible problem on banks' assets, in the sense that if people or firms use at least part of that money to deleverage, to pay back debts with other players, then also there's a problem for banks' profits, which could, beyond certain level, imply a problem also of financial stability. So what we do today, of course, given the topic of the workshop, we will instead focus on the possible distributed impacts. And given what we've been talking about yesterday, today we have also put in as another scenario the Passionetti rule, just to add some pepper there. We use a model developed by Sylvio and Passarella because, on the one hand, this has been thought to represent an economy in secular stagnation. And even though this is very much an American debate, the really stagnating economy is the European one, at least for yes. So it is really, I think, fitting. And second, because they have an assumption about how to represent quantitative easing, which is our reference point. So we will compare the issuance of CBDC with traditional quantitative easing. The way, let me go there and then I go back. The way that Passarella and Sylvio think of quantitative easing is the central bank buys more bonds, for example, from upper class households. So we will have a model, I will show you in a second, where there are working class and upper class households. The upper class households, therefore, at the end of the period, have fewer bonds. And according to a typical Tobin-like model, they will decide to allocate more resources to deposits with the banks, short-term and longer-term deposits, and equities. We have made, to be honest, a slight change in Sylvio's and Passarella's treatment because we wanted to help a little bit the quantitative easing scenario, which does not perform too well in our simulations. So we have changed slightly the bond market, assuming that the price of bonds depends on what we call potential demand, which is the full demand for households at the beginning of the period before the central bank buys these bonds, plus the demand from the central bank. So basically what happens is that when the central bank engages in quantitative easing, in our model, this drives up a little bit the price of bonds, which means it reduces a little bit the interest rate on bonds. We wanted to help this scenario, to be honest. Then, as I mentioned, we have two kinds of households. Upper class households have all forms of income. So they have a little bit of wages, maybe transferred from the government. We said that's 0% basically. They have rents from bank accounts and from bonds. They have profits for banks, which basically here contains the revenues from loans to firms, and the distributed profits from firms. Instead, you have lower class households that only earn wage income. Then, of course, they also earn public transfers, but as I said, we don't consider that. So we will consider two measures of inequality in this model. One is the disposable income of the upper class as a ratio of the disposable income of the lower class, and the other is the capital incomes as a ratio of GDP or of disposable household incomes as a ratio. Now, as everybody has done today, we're not going into all the details of the model. There are 7 sectors, traditional ones: firms, banks, central bank, government, and foreign sector. The only peculiarity is the distinction between lower and upper class households, and then you have some sorts of financial assets. The most interesting one, well, the new one, let's say, of our paper, is that we have the possibility for the central bank to credit CBDC, so currency, to either kind of households, then let me say we will not consider the case in which the central bank only credits CBDC to the lower class households, because this will reduce inequality trivially. That's not really an interesting scenario. And as I said, we represent this crediting as a loan, so we also add a new asset to the central bank's balance sheets, and we have a new liabilities for households. Why did I say that it doesn't change anything? Because if this was a grant, then you would have an increase in households' net worth, which is also written on the liability side. So really, there's no distinction here. Now, we have given up from the very beginning the idea that we could replicate the dynamics of the European economy in the short term. So really, what we have tried to do, we consider the period from the euro to excluding the COVID crisis. And we have tried to replicate the long-term dynamics of GDP, the unemployment rate, productivity, and then I will show you some other variables. Long story short, you might have heard about a number of shocks of the European economy. So what happened is that first we had, of course, a global financial crisis with a slight delay with respect to the US. Then the price of our own making from 2010, a first period of hard austerity during which we had more unemployment, less GDP growth. Then austerity actually softened a little bit. This was also related to two or three stages of monetary policy that I will tell you in a second. Long story short, we basically cut through and take the long-term trends of the variables of interest. So this is a particularly important in terms of monetary policy, because in our baseline, and this possibly answers to some of the questions, if you don't want the Bassi-Netti rule, what should we replace it with? So what this is not normative, but as a reference point, our benchmark is a situation in which the central bank actually doesn't change the interest rate. So it's there. We have decided the long-term trends observed during the same period. Of course, you will know that, for example, the ECB actually had increased rates at the beginning of the global financial crisis. Now, then it decreased, then it started increasing again, then they will never take speech. So it will be too difficult to replicate every single move there. We just have, taken the long-term average. What happened in Europe in this period in terms of inequality? We have considered, based on household surveys, the same ratio of disposable income of rentier families, so to say, to worker families. In actual practice, the average of the Eurozone first goes up and then goes down. But as I said, in our baseline, we take the long-term trends. The wage share in Europe over this period has really been stuck. It didn't move. So this is the rate of change, just so that you can focus a little bit more. You see the highest rate of change has been 2%, but only, in a very peculiar period. Otherwise, normally the wage share has been there over this period. What do we do on this baseline scenario? We consider four kinds of policies. One is the central bank credits CBDC to all households, so both upper class and lower class, for 5% of GDP, which, as I said, is roughly the maximum amount the ECB is foreseeing in its plans. How will this affect our economy? It will increase partly also the net, depending if it's a loan or if it's a grant, it will increase either gross assets or also the net worth of households, and this will produce an increase in consumption and therefore more income. Second possibility, the ECB targets firms instead of households. We were interested in this scenario, not really because we want to fine-tune the predictions, but really because, as I said, it is interesting for us to consider something that is not currently debated, or at least not enough, which is, in the case of firms, we assume that they use the ECB to pay back the banks. And this implies lower leverage for firms and therefore a little bit of higher investments. But as we will see, it will also imply less rents for upper class households, for banks, and therefore for upper class households, and therefore less consumption. Okay. Then we have quantitative easing. It works the way that I have already explained. And we devised an hypothesis of a fascinating rule in two ways. One was that the one that you don't really like. The central bank adjusts the interest rate in every single quarter, always setting it equal to productivity growth plus the inflation rate. In the other case, it considers that what we have assumed, a moving average of the 2 previous years, so 8 quarters. To be honest, I'm going to show you this one because it has even less cyclical oscillations than the other one. The problem, at least in our simulations, when we assumed the moving average, was that the ECB was basically always reacted a little bit too late, thus increasing instability instead of lowering it. Okay, so let us move a little faster. So how does the CBDC scenario work? The central bank has a new liability, and it writes it down as a loan to the households. In this case, households will have a new liability, which is the loan from the central bank, and the new money in the new bank accounts directly with the central bank. If you want to think instead of a grant, as I was mentioning, the main difference, and the reason for we are not really considering this scenario, is that the way you should write the issuance of new CBDC would be by reducing the net worth of the central bank, which I have nothing against in principle, but I'm not sure our friends at the Bundesbank could agree with. So I don't think that is what will be done in practice. But really, it does not change basically the working of the model of the main transmission channels. So let us ignore this problem, to be honest. To first, I already explained, so let me go a little faster. I have given some previews of our main results. So I'm also telling you in advance that we have made 3 tweaks to Passarella's and Soya's model, again, because we are trying to make the CBDC scenario less effective, and we are trying to pump up a little bit quantitative easing and the scenario of the fascinating rule. To do that, we do 3 main things. One, we include a wealth effect, which in practice in our model is really a monetary illusion. When the price of bonds goes up, or the price of equities, households will decide to consume more. I call this a monetary illusion because these are unrealized capital gains. And in this economy, which is mostly a closed economy over the period, it is really unclear who would ever, pay more for these assets. So that, okay, I really see that as asset inflation, to be honest, but yet we assume that it has a positive impact on consumption. We introduce a negative elasticity of firms' investments to the interest rate. I know that post-Keynesians should not believe in that, but as I said, we needed to pump up a little bit the quantitative easing scenario. And we had assumed basically Piketty's hypothesis. So we assumed that whenever the GDP growth rate is greater than the rate of interest, or the rate of interest specifically on the upper class household assets, then there is concentration of wealth, which helps a little bit the fascinating scenario in the sense that we represent these as an increase in the share of upper class households and a decrease in the share of rents ceteris paribus. So to come to the main results, in terms of GDP, the 3 scenarios are not directly comparable. At least 3 are and 1 is not. This is a shock of 5% of GDP, 5% of GDP, and 5% of GDP. This instead is a change in the interest rate. So please keep that in mind. They are all associated of a continuation of the slow growth of the European economy. However, the CBDC to household scenario is the one that both in the short run and in the long run has the highest impact on GDP. Then comes the CBDC to firms. Quantitative easing first has, let's say, a short-term impact, but this fades away. And this is something that not everybody might like. The Pasinetti rule at first had a positive impact on GDP, but in the long run, it doesn't really help. So it really would need fiscal policy that we're not considering here. Okay, so let me also stress that this is not a negative, this is not a decrease of GDP, it's just a lower increase with respect to the baseline. Okay, otherwise it looks too scary, I understand. What are the transmission channels basically? So mostly in the case of, and this also explains why the Pasinetti rule has lower growth than the other scenario, we have after a short while an increase on inflation. You can call it conflict inflation or demand pull inflation, call it however you want, but the central bank reacts to that and increases the interest rate. So this is one of the problems in our model. You have the asset price inflation that was mentioning. This is the most positive impact on consumption. And you had a decrease of the interest rate in quantitative easing and at first also with the Pasinetti rule on bonds. The problem, if you want, but not really the problem, is therefore that the scenario of CBDC to households is the most effective increase in GDP because it increases consumption, which in Europe is the, well, in many countries except China maybe, is the biggest component of aggregate demand. The Pasinetti rule and the CBDC2 firms are much better at increasing investments, which however in Europe are nowhere to be seen. And therefore, even if it is an increase of 2% with respect to the baseline, this is too small to create a really positive impact on GDP. I'm not going to repeat so much. So let's come to the effects on inequality. As you can see, basically, the CBC2 firms even has a better, it's very small to be honest, but it decreases a little bit personal income distribution inequality. And this happens, as I mentioned, because firms pay back their debts, therefore they pay less rents to banks, and banks transfer less rents to upper class households. So the ratio of upper class to lower class households decreases a little bit. The CBDC to households doesn't really have an impact, except that it reduces unemployment, so at first it benefits lower income households, but this is really a very small effect. The Pasinetti rule is effective. We will see in a second. There is also a peculiar effective related to what something that Sergio mentioned before, and that's, I don't know, maybe you were expecting, maybe not. In the sense that if we consider the share of functional income inequality, the share of wages to GDP, this increases most for the CBDC2 households scenario because it has the biggest impact on GDP. So it reduces unemployment, and this way it increases the wage share of GDP. Instead, this decreases in the Pasinetti scenario. So how is it possible that you have a decrease of personal income inequality and instead an increase, if you want, of functional income inequality? The answer is that the Pasinetti scenario, at least given our parameterization, really drives down rents. So even though profits increase, this is, if you want, an overall change that doesn't change the share of wages at GDP, more or less. No, in the Pasinetti scenario, it was here. Well, it decreases a little bit, but not dramatically. Instead, the dramatically shift is from rentiers to capitalists, if you want. In the case of the CBDCs, in both cases, there is a reduction of rents, much larger in the CBDC2 firms. I have already explained why. An increase in profits in both cases, simply because GDP is increasing with respect to the baseline. So, coming to the conclusions. First, I wanted to highlight that in our parameterization, we have been trying to be as conservative as we could. So mostly the positive impact of a CBDC2 households is driven by the propensity to consume out of wealth. Estimates for Europe tell us that this should be between, let's say, 1 and 3%. Instead, we have taken 1.6, trying to be on the low side of the estimates. Impacts on investments depend on leverage, Tobin, and interest rates. And we have taken, as you see, exorbitant parameters, much larger than those currently estimated by the literature. And still, you know, those kind of policies that really try to use investments as a leverage don't have nearly the same effects on European GDP as the ones that instead rely more on consumption. Finally, I found it interesting, maybe you already know that very well, that there could be an important difference between personal income inequality and functional income inequality, but not in the direction that I had in these 2 days, in the sense that apparently in our parameterization, the presenting rule is much better to reduce personal income inequality than functional, if by functional you mean the wage share. Because in our parameterization, what you have is really a shift from rents to profits, not to wages. And then this is up to the date. CBDCs, to be honest, don't have a huge impact on the distribution on let's say, functional income distribution, except again, if some of this money should be used to the leverage, that will lead to a reduction of rents. So overall, a little bit the same conclusions that I was making also in the blog post. I think a lot of people think of digital currencies as, you know, some weird idea of crypto goes in California. At least in the case of CBDCs, instead, they can be really relevant. There is a potential, let me just show you the case of GDP, but also for employment will be the same. There's really a potential for a very, very effective new monetary tool. Maybe it will not change the world, you know, even to the amount that we are mentioning. So a shock of 5% of GDP will increase to a higher level of GDP than the baseline of less than 5% actually in the long run. But given that all the other instruments tried by the ECB have not been super effective, in my opinion, a new instrument is still something well. Thank you very much.